Hey, in today's video, we're going over 9 frequently asked questions about Roth conversions. If you're thinking about doing Roth conversions, stick around. Hey, my name is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need individualized help, go to christycapital.com and click Talk to an Advisor. Today, we're going to be talking about Roth conversions, and we're going over 9 frequently asked questions. The first question is there a growth cost when you do Roth conversions? So when you do a Roth conversion, you're taking traditional money and you move it to Roth, and when you do that, you have to go ahead and pay the taxes. So let's go over an example for some easy numbers. Let's say you have $1 million traditional TSP or a traditional IRA. And let's say for this example that you'll always be in the 22% bracket. Like no matter when you do your taxes, when you take a distribution, you're just always going to be in the 22% bracket for this example. With those parameters, that means that your $1 million balance is not fully your $1 million balance. $780,000 of the balance is technically yours, and $220,000 of the balance is technically the IRS's. You just haven't paid them yet. Remember, traditional money is tax deferred. I'm deferring it later. But later you got to pay it. So let's say that you converted the entire $1 million and stayed in the 22% bracket. Now that wouldn't be the case in actuality, but let's just say you did it. If you Roth converted it slowly over time, you could remain in the 22% bracket. But for this example, we're showing you doing it all at once just so you can see the effect. So some people view this as my $1 million balance has now dropped to $780,000. As my Roth account grows, I will get growth on the $780,000, but I will not get growth on the $220,000. Is that a growth cost I'm paying? Since my balance is smaller, there's less money there to grow. So wouldn't it be wiser to just keep it in traditional? Well, let me see if I can get you to look at this in a different way. Even if you let the $1 million stay traditional, as it grows, the $1 million balance does grow. But remember, technically only $780,000 of the money is yours and $220,000 of it is the IRS's. So if your traditional account grew, would your portion grow? Yes, it would. Would the IRS portion grow? Yes, it would. If you can view your traditional account as what portion is actually yours compared to what portion is actually the IRS's, you will see that there is no growth cost. The portion of your traditional balance that is actually yours is the same amount that you would get moved over to Roth. The only part that is leaving is the IRS's portion. That part that you're paying in taxes technically wasn't yours to begin with. You were holding it for your favorite uncle, Uncle Sam. So once you can see your account from that perspective, you see that if your traditional account goes up by 10%, your $1 million goes up by $100,000. But with the $100,000 growth, $78,000 of the growth would be your growth, $22,000 of the growth would be the IRS's growth. So even though your balance is bigger, it just means you owe more to the government in taxes. If you moved your $780,000 over to Roth and it grew 10%, you would earn $78,000. I think it's important to understand your portion of your account versus the IRS portion of your account. Once you see it from that perspective, you'll see that there's not a growth cost in Roth conversions. Keep in mind, for this to be so, tax rates have to remain constant. As long as the tax rate remains the same, there's no growth cost. If tax rates get worse over time, then a Roth conversion wins. Tax rates get better over time, then traditional wins. So which do you think is more likely? The second question here is, what is the best way to pay conversion taxes? Now there's a couple of options here. Now the one that is used most often is withholding taxes from the Roth conversions. Let's say, for instance, that $100,000 gets Roth converted and we withhold $22,000 to pay federal taxes at 22%. If we withhold the taxes from the conversion, then only $78,000 is showing up in the Roth account because $22,000 went to pay taxes. That's one way that you can pay taxes. Now, if you are in the TSP and you've just retired and you're under the age of 59 and a half, one of the things we help clients with, we move a good portion of the TSP into an IRA, and we help them start doing some Roth conversions from the IRA. But since you're not 59 and a half yet, you can't withhold taxes from the conversion because that would be deemed an early distribution and would have a 10% penalty. In those cases, instead of doing a $100,000 conversion and withholding $22,000 for taxes, we would actually do a $78,000 conversion and not withhold any taxes. You could then go to TSP and do a $22,000 distribution and instruct TSP to withhold 100% for taxes, which in essence is having the TSP send the $22,000 that you owe to the IRS for you. A third way to pay conversion taxes is just write a check for it. In our example, you would do $100,000 conversions and not withhold any taxes. Either at the end of the year, you could just pay the taxes, or you could write quarterly checks and pay it ahead. But you'd basically just write a check from your checking account or from some other non-retirement money and pay the taxes on your own. Now, what's great about this method is that it lets the entire $100,000 be converted. The amount is not lessened for taxes because you're paying taxes from another source. This may be the most efficient and effective way to move as much as you can as quick as you can. Now, the third question is, when do I have to pay the Roth conversion taxes? There again, most of the time people are withholding the taxes from their conversion, which means the tax money gets sent ahead for you right away. But another option that people bring up is, what if I do a Roth conversion and I don't pay the taxes right now, and I want to wait until next April, not until I file my tax returns. And if I owe something, I'll pay it then. So what are the rules on paying quarterly taxes versus waiting until the next tax return? One way you can avoid doing quarterly taxes is if your withholding for the year will cover 90% of your tax liability for this year, or 100% of your tax liability from last year, whichever is smaller. The threshold is 110% if your adjusted gross income last year was more than $150,000 married filing jointly, or $75,000 filing single. Most of the time, if you're doing a Roth conversion, it's causing taxation that could cause you to either want to pay your taxes by withholding it right away or doing quarterly taxes. You don't want to do a really large Roth conversion and not withhold any taxes and just wait until next year, because there could potentially be some penalties and interest that could be owed by not paying it, in a timely manner. Please check with your tax preparer if you are wanting to not withhold taxes from your conversions. So the fourth frequently asked questions is, I have little to no Roth. What should I do? Well, to answer this question, it will depend on your situation. Now, the majority of the people that we talk to are somewhere between age 55 and age 65, and they've saved somewhere between $500,000 and $1 million in their TSP. If that sounds like you, then there's probably going to be some tax issues in your future. Now, why would I say that? Well, you're going to have a federal pension. You're going to have Social Security. If you're married, you're going to have another Social Security. If you're single, you won't have that extra Social Security check, but you're going to be on the single tax bracket, which can sometimes be penalizing. When you start adding up your income, it's going to be higher in retirement than you may have thought when you first started working 30 years ago. If you listen to some of the financial experts out there, they'll say that, when you're going to be retiring in a lesser tax bracket. And I'm just saying, dealing with federal employees, I don't see that. Most people we talk to when they're working, they're like in the upper 22% or the lower 24% bracket. And when they retire, they drop down to probably the lower to middle 22% bracket. So for most people, they're in the 22% bracket working, and they're in the 22% bracket retiring. And so when you throw in that you've got like a $500,000 or $1 million TSP balance, and you let that continue to grow until your RMDs kick in, that's your required minimum distributions, it could actually bump you up into the 24% bracket. So if you're one of the few people out there that we don't typically see, when you're going to drop tax brackets a lot in retirement, then you might be doing the right thing to just keep doing traditional. If you're going to drop a lot of tax brackets in retirement, traditional probably wins. But if you're like most people that we talk to from the federal government, you're going to be in a similar tax bracket later. Now, do you think the tax brackets, meaning the actual rate on the bracket, is going to stay the same, like 10 years from now or 15 years from now? I would probably argue that taxes almost have to go up to pay the mounting debt and all the spending that the government does. And with interest rates going up, that just means the government has to pay back all this debt at higher interest rates. If you think taxes are going higher and you have little to no Roth, it would be my recommendation to look at doing some tax planning. A systematic shifting of money from traditional to Roth can be wise planning if you think tax rates are going to be worse one day. While you're working, you can start contributing to Roth TSP if you want to. Once you reach age 59 and a half, or whenever you retire at whatever age, you can start doing Roth conversions in an IRA. The name of the game is that you want to pay your tax at the lowest rate. You need to figure out, what are you paying now? What do you think you'll pay later? Wise planning is choosing to pay at the lower rate. If the lower rate is deemed to be right now, then starting to do Roth could be wise. If the lower rate is deemed to be later, then staying with traditional could be wise. The fifth frequently asked questions is, are there income or size limitations when doing Roth conversions? So with Roth conversions, can you do it with any income? And the answer is yes. There are no income limits. Warren Buffett could do a Roth conversion if he wanted to. Now, are there size limitations, like the amount that you Roth convert? No, there's not. You can Roth convert any amount that you want to. So let's say that in our previous example, we were talking about you having $1 million traditional IRA. Could you Roth convert the entire $1 million all in 1 year? Well, yes, you could. Would that run you right up the tax bracket into the top tax bracket? Yes, it would. So most of the time, people are limiting themselves based on the tax bracket that they are willing to pay. Maybe in your situation, you're willing to max out the 24% bracket. You would figure out how much room would you have until you max out that bracket, and you could convert that amount. You're self-imposing the limit because you don't want to pay 32% tax on it. The only limitations are your own. So ask yourself this question: what if tax rates go up? The whole reason that you're thinking of doing Roth conversions is that you're afraid taxes are going to go up. You're willing to pay the tax now to avoid what you think may be worse taxes later. If taxes go up, you still have to ask yourself the same question. Based on where taxes are now, do I think they'll be worse in the future? The name of the game is that you want to pay the taxes at the least rate that you can. So even if taxes go up, are they potentially still lower than what they could be 25 years from now? You'd have to make up your own mind. The sixth frequently asked questions is, what if I'm younger than 59 and a half? Can I do a conversion then? And the answer is yes, you can. The distinction comes in how you're going to pay the taxes owed. You can't pay the taxes by withholding it from the conversion because that would be deemed an early distribution and hit you with a 10% early withdrawal penalty. So yes, you can do a Roth conversion, you just need to find another way to pay the taxes somehow. So the seventh question, what are the differences between converting while working versus converting while retired? Can you do both? Well, the distinction will come in with what's your income. Most of the time we are determining a tax bracket that you're willing to pay the tax rate at. For instance, maybe I'm willing to pay 24% taxes. So based on our otherwise income, how much room do I have to Roth convert? Now, possibly while working, you'll be making a little bit more money, which means you can still Roth convert maybe a little bit, but when you retire, your income may go down a little bit, which gives you, some more room, or maybe you could do a little bit more Roth conversion. The point is that you can Roth convert in both instances. The amount that you want to Roth convert may differ based on your income. So the eighth question is, what if Congress eliminates tax-free Roth? Well, there's been no indication that's even on the horizon. If anything, some of the new legislation coming out is forcing people to start using Roth more. For instance, the Secure Act 2.0 has a new rule starting in 2026 that requires the catch-up contributions to TSP to go to Roth at certain income levels. Right now, you can choose to have it go traditional or Roth. But in 2026, if your income is above $145,000, then the catch-up contributions will be forced to go to Roth. Why is the government doing that? They don't want you to have the tax deduction today. They want you to go ahead and pay the tax. I guess it's their way of collecting more tax dollars today by forcing you to go to Roth. Another reason I don't think they'll eliminate Roth is that if you look at the total amount of retirement money out there nationwide, the vast majority is traditional. There's not that much Roth out there. And so if they want more tax money, all Congress has to do is raise taxes. Because whenever you take out a distribution from traditional, you have to pay whatever the current tax rate is. If they raise taxes, they're raising it on all traditional money. Going back and trying to make tax-free Roth somehow not tax-free later is not something that I think will happen. And then the ninth question is, do I have to wait 5 years to access my conversion? So with Roth IRA, there are two rules. There's a 59 and a half rule, meaning to take out gains, you need to be 59 and a half, and you have to have had a Roth IRA account for 5 years. And so it's why we encourage people to go ahead and start a Roth somewhere, because you need to start that 5-year clock. But if you do a Roth conversion and you're over the age of 59 and a half, so you're over 59 and a half, you pay the tax, you Roth convert it, you can access all of it right away. If you're under 59 and a half, you can Roth convert it over. You'll have to wait 5 years to be able to touch that Roth conversion amount. So if you're making a contribution, I'm gonna write a $7,500 check to my Roth account. I can access that now, anytime. It's my basis. Can't touch the gain until I'm 59 and a half. There are some time restrictions. There are some nuances with touching a Roth conversion because it depends on the age that you do it. There's also a couple of other rules you can check out, meaning if you've got certain medical issues, if you're buying a first-time home up to a limit, there's several limits that don't generally apply to people that we're helping with that are 60 years old plus. Most of the time, if you're over 59 and a half, you can access your conversion whenever you need to. Remember, one of the reasons we're doing the Roth conversion is we're trying to get the money moved over so that it can grow. And so, most people aren't wanting to access it soon. They want it to stay there. They have other money they're going to be living on and accessing if they need to. So that's something to keep in mind. Now, hopefully these questions have helped you get a little more clear on some of the benefits of Roth and how to do Roth conversions. This is definitely something that, if done well, can make a big difference in your financial planning. If you've got $500,000 or more in your TSP, there's a good chance that there's going to be some tax issues in your future. If you get to required minimum distribution age, there can be some large distributions that are forced on you and they're taxable and they can bump you up into the next bracket. If you have those big RMDs and you're married, but then either you or your spouse dies and then suddenly you get moved to the single tax bracket, you're still going to have those large RMDs and it can actually run you up the bracket faster. Both of these instances can be fixed with the systematic shifting of money from traditional to Roth using Roth conversions. This is something that you can do on your own, but it's also something that you can mess up on your own. And the mess ups come from either not converting enough to do the heavy lifting before increased taxes. That would be a problem. The other is Roth converting too quickly and running yourself up to the tax bracket where you're actually going to be paying more than you otherwise would have. Getting it right is important, and that's something that we help clients with. If you need help, go to christycapital.com and click Talk to an Advisor. If you're wondering, are there reasons why you may not want to do Roth? Well, check out this video right here for reasons to not do Roth. Hey, my name's Mel Stubbs. I'll see you on the next video.